So income statement using absorption versus variable. Again, don't get caught up. You know absorption costing. This always threw me off, and it threw off all the other students. So many students I've known. It's like absorption costing. We have to learn a third method. No, you know this. This is a gap. Just include your fixed overhead. Super simple. Variable. Exclude fixed overhead. And then you know how GAAP financial statements look. We have sales minus our cost of goods sold. Our cost of goods sold is for that $25 per unit, right? We include it. So the $25 per unit means our gross margin is $900,000, less our selling and administrative expenses. It didn't include any kind of selling and administrative costs. So this is just a new fact pattern, right? Our variable and fixed overhead is included in our cost of goods sold. And then here, how is that different than our variable cost units produced equal units sold? Or just our variable costing versus absorption costing? The difference is here are $15. Our variable expenses are 15, right? Our overhead. Well, here we have 25. So here in the variable costing, we're excluding this $10 per unit that we calculated, the fixed overhead. We exclude it here, but we include it in the absorption costing. And so we get a contribution margin, 1.38 million, which is much higher than our gross margin under absorption costing method. And then you can see our fixed expenses, our fixed overhead is all down here. And our fixed selling and administrative is down here as well. They're showing here that our selling and administrative expenses is a period cost. So our fixed and variable selling and admin are a period cost here. While in our variable costing, our variable selling and admin go into our variable expenses, and our fixed selling and admin go into our administrative expenses. I always feel like this, it can seem overly complex. It's really simple, right? At the end of the day, this is just GAAP. GAAP accounting has it so that all of your costs of goods sold get allocated to cost of goods sold. That includes your fixed overhead. And then all of your period costs, or SG&A, selling and administrative, general expenses, research and development, are separate. They'll be fixed and variable. Well, variable costing, you just have your variable costs. So if it says it's variable, you put it in variable. And if it's fixed, you put it in fixed. It's that simple, right? You already knew this from your last class, and now you know this. So don't get too thrown off by what absorption is versus variable costing. You know these concepts. Just remember variable, split the variable and fixed. Absorption, fixed overhead goes into cost of goods sold, and SG&A, selling, general and administrative, stays separate. That's it. And then production cost assignment, units produced equal units sold. And so here, they're just showing you beginning finished goods inventory under absorption versus variable, and how all the costs reconcile. And again, this goes back to what I said class 1, right? We're just allocating the costs. So direct materials are going to be the same, part of cost of good manufactured. Direct labor are going to be part of cost of good manufactured. Variable manufacturing overhead, part of cost of good manufactured, right? Now we have our difference. I'll repeat it 100 times, right? Variable overhead. Fixed overhead. Fixed overhead is part of absorption costing, cost of good manufactured. It's not going to be cost of good manufactured in variable costing. Why? Because it's not variable. So cost of good available for sale and fixed manufacture. Our cost of good available for sale total, we 900,000 here. Look familiar? Let's see. 900,000. While here we have the 1.5 million, which is cost of goods sold, 1.5 million. Then we have a cost of good available for sale, less ending finished goods. We didn't have any finished goods. We have different costs of goods sold for variable costing and absorption costing. So just know that here's how the differences are. That all the same though, variable costing, variable and fixed. That's how they bucket it off. Absorption, we bucket off to inventory based on GAAP rules, which include fixed overhead. So other than that, don't get too caught up in it. Now let's say we produce more units than we sold. How would this income statement look from an absorption costing and variable costing method? These patterns of behavior are useful just for your cognitive functioning. I want you to be able to think of cost relationships this way. So this I want you to memorize. If I produce more than I sold, from an absorption costing standpoint, my net income will be higher than my variable costing. Why? Because if I produce more than I sold, my cost of goods sold, 40,000 times 25, that 25, we have a footnote down here, all those costs, right? We include our fixed overhead, nothing new there. Our gross margin drops. And then our selling and admin expenses are 280,000 because we allocate 40,000 to it. 40,000 times a 2 plus the 200,000 of fixed costs. So our net income is 320,000. For our variable costing, however, our sales are 1.6 million. And our variable costs, again, we just look at variable production costs, variable selling and administrative to get our contribution margin. And then we look at our fixed costs below the line as period cost to get our net income. Income for our absorption costing, 320,000. We just walked through this. The net income is only 120,000 under variable costing. So this is just explaining the slide above. I don't want to spend too much detail. We went through all these calculations. Units produced in excess of units sold. We can see this is going to be our cost of good manufactured. So less finished goods inventory, right? We have finished goods now in both cases. So our finished goods will be lower under absorption costing and higher under variable costing. Wait, let's see. Were there less finished goods? Less under variable costing and more under absorption costing because of the allocation of the fixed overhead to that bucket. And so, again, we have all this calculation. Again, this is just coming from earlier slides of multiplying out and including the fixed overhead into our inventory. We have a cost of inventory available for sale. We don't sell all of it, right? We produced more than we sold. So we're going to have ending finished goods that is higher than the variable because the variable doesn't include that fixed overhead into the cost of sales, right? And so we have the fixed manufacturing overhead going into our period costs, but because they're in our period costs, it's going to reduce our ending finished goods inventory. So we have more costs capitalized here while we're expensing more based on the period under variable costing, which is helpful under variable costing because we can actually see the cost we spent in the month. While under absorption costing, it's all capitalized to inventory. So we really don't get to see, well, how much money are we spending on all these other costs in the month. So that's where the fixed costing or variable costing is more helpful. Now the relationship flips if we do units produced less than units sold. And so net income in this case will decrease, will be less than, under the absorption method, will be less than variable costing. And so we can see how that relationship flips, right? Let's see. Units produced excess, net income 320. So it's greater than, right? Absorption costing. So if I asked you if units are produced in excess of units sold, which has a greater net income, we'd say absorption costing. But if I say if a unit's produced in less, which has a greater net income, it's variable costing. And why is that? It's all because of the fixed overhead allocation. That's all. Because if we produce less units than units sold, we're not going to be allocating that overhead to this period. And so because that overhead's in our cost of sales. And so there's going to be less costs associated in our absorption costing than in our variable costing. And that's where this distortion comes from. The whole point is if we produced less than we sold, from a variable costing standpoint, this is going to more accurately show us how much more money we're spending in the period than while this is showing us how much, while absorption costing is showing us how much money we spent related to when the inventory was produced, right? Because of the matching principle. Expenses have to match when revenue is recognized under GAAP accounting. And so it's distorting that monthly perception. know that in GAAP accounting, we're really looking at normally quarterly and yearly financial statements. While internal reporting, we're looking at monthly. So in GAAP accounting, this kind of monthly difference isn't as significant, except at quarter ends and year end. While we want to know from a planning perspective, normally inventory monthly, right? Which makes variable costing more useful. So we'll say here, same thing, sales, we sold more. The way to another say this is we sold more than we produced. So we sold the 80,000 units. And we have here the variable expenses, contribution margin, and we have our fixed expenses. That doesn't change, right? So our variable production costs are 80,000 for the amount of units here. Cost of goods sold, 80,000 times the 25. So we can see here that I can walk through all these calculations a million times, but I think you guys can calculate the simple math here. 8,000 times 40. You can see here that ultimately our net income will be less in the absorption costing. So just be able to know the relationships. If we sell more than we produce, absorption will be lower than variable. And if we produce more than we sell, then it'll be the reverse relationship. And that's all this slide is saying. It's just reiterating that fact. And then ultimately, we'll have more cost of goods sold under our absorption costing than our variable costing here, because some of that units that we sold have fixed overhead allocated to it, right? The fixed manufacturing overhead we allocated to our cost of good manufactured from previous periods. All the fixed manufacturing overhead here is just part of fixed manufacturing overhead. It's not included in the product costs. And so that's our cost of goods sold will be more smooth under our variable costing. So just know these formats, right? You'll be testing your homework with these formats, but in the midterm, I'm really going to be focusing on just your concepts of what method, higher level, what method has a higher dollar value net income if units produce less than units are sold. We produce less units than we sell. Or I might ask you, what is our net income given this scenario under absorption costing? What is our net income under variable costing? Or what's our contribution margin? Those simple questions. I'm not going to ask you to do a full-blown analysis.